Okay, well, there was a live look at what's happening with the U.S. and Canadian stock markets on this Friday. And as we wrap up June, we have seen some momentum in this final week. Now, keep in mind that the Canadian stock market has lagged the U.S., where the AI frenzy has pushed up a number of tech stocks that have greater influence. As for where we go as we start a new month of trading and beyond, let's get some insight and analysis from Alec Young. He's Chief Investment Strategist at MapSignals. Alec, it's always great to see you. Happy Friday.
Happy Friday. Thanks for having me.
Let's just start with how you're overall positioned. Do you think the stock market has more room to run after a year where we've been talking a lot about record highs?
Yeah, absolutely. Our core macro thesis for why we've been positive on stocks is disinflation. Inflation continuing to come down, giving the Fed scope to cut rates later in the year. And we just got the PCE numbers today. 2.6% on core PCE, the Fed's favorite inflation metric, and that's the lowest print we've had in a long time. So we're continuing this trend. So we think it's just a matter of time before the Fed cuts rates. And the months leading up to the first cut are generally very positive for stocks. The market's sort of pricing in a more accommodative monetary policy backdrop. So that's really the biggest reason that we're staying positive. Also, of course, is very strong earnings momentum. So you put those two things together, and we don't really see a reason to turn bearish.
So let me then ask a sector question, Alec, because for the year overall, if we're talking about the S&P 500, most of the key subgroups are positive. But over the last 3 months, as you well know, you've had the haves and the have-nots. So technology has done quite well in the last few months, whereas for the S&P 500, you have financials, industrials, energy, materials are all in negative territory, healthcare. I mean, these are some important groups. So if the market was going to continue to gain ground, where do you think the pockets of opportunity lie?
Well, bull markets have an amazing way of rotating their way higher. So it's very hard to game out who's going to lead on any given day, but the market finds a way to keep moving higher. So we're going to continue to see that rotation. The biggest thing holding cyclical sectors back, a lot of the sectors you talked about, financials, industrials, materials, energy, small caps, we've had a lot of fits and starts there. Some good performance, but then some poor performance. And when you add it all up, it hasn't been nearly enough to keep up with tech. But that's been based on cyclical concerns, worries that the economy is slowing. We could go into a recession. The Fed's waiting too long to cut rates. So these cyclical concerns have held those groups back. If inflation keeps declining, the Fed signals that rate cuts are really finally here. And we think July is actually a live meeting. The consensus is they won't do anything until September, but we have seen a modest softening in the economic data. Inflation's continuing to fall. So they could cut sooner than a lot of people think, but that will give people confidence in the cyclical outlook. And I think it'll allow a lot of these cyclical areas to play catch up. But we still very much like big tech. And so it's really, we've been talking about a barbell. You have to own big tech, but there's a lot of opportunity on the cyclical side, and there's also great opportunities in more defensive areas like healthcare, staples. So it's really an opportunity to own a wide variety of stocks. If the economy hits a soft landing, the Fed's easing, earnings continue to climb, we think there's room for upside in a wide variety of sectors.
Okay, and then on tech, if you see outperformance there, how often do you get the question, but look how much the AI stock leaders have moved? And I'm reminded of what happened to companies like Cisco or Nortel during the dot-com boom. What would you say to people who are nervous just because some stocks have moved so far so fast?
Sure, and we are seeing corrections, one by one. Apple had a big correction, Nvidia's cooled off, but that rotation kind of keeps the overall market rally intact. And there's a lot of earnings support and tremendous dominance by these big companies that we didn't have during the tech bubble 30 years ago. Even the big companies like Cisco that led the way weren't as dominant as the big tech companies are today. Wasn't as big, wasn't nearly as profitable, as entrenched in everyday life. So I don't really buy the analogy with the tech bubble of the late 90s. You know, the valuations in tech are higher than the rest of the market. But if you adjust it for how fast their earnings are growing, it's still quite reasonable. So the overall market trading at about 17 times, 21 times when you factor in big tech. But, you know, the big tech is putting up 20% earnings growth. So on a PE to growth basis, it's a one peg ratio, which is really quite reasonable. So I think it's quite difficult to come up with, you know, a cogent bear case. Sure, we could have some volatility pullbacks. We've seen that before this year. Those are healthy. But to really argue for a major change in the trend of the market, you really need to underpin the argument for Fed easing. You need to undercut the earnings story, the economic growth story, and we just don't see enough data to support that.
Okay, let's talk a little bit about the fact that this is an election year. Everybody's talking about the big debate last night. What generally happens to the stock market in a presidential election year?
Yeah, we found some really interesting data. At MapSignals, we track institutional money flow, and we've noticed that the big institutions historically in presidential election years, going all the way back to 1928, the S&P was born in 1926, so our data captures every election since. But we consistently see, at least in the modern era where we have the best data, heavy institutional selling in September and October in election years. Those are negative months, 0.5% and 0.3% respectively for those 2 months. But then once the uncertainty of the event, the election's over in early November, we see very strong gains in election years in November and December, 1.4 and 1.5%. So basically, our message is, you shouldn't sell around elections. And if you see selling going into the election, take advantage of it as a buying opportunity, because history says that the end of the year in an election year is very strong, November, December. And the first year of a presidential term averages an 8% gain historically. So the only year in the presidential cycle that's really worth sidestepping is the second year, the midterm year, where the markets average basically flat returns. But at this point in the cycle, investors tend to get very nervous around elections. That's understandable. There's a lot of candidates highlighting major problems, and the campaigns are amplifying those messages on social media. But history shows that bailing out of stocks around elections has been a bad strategy. We have data that shows people buy 4 times as much money market funds as stock funds and ETFs during election years. People get very nervous, but the data shows that that's a mistake. You should actually be buying weakness going into the election if you have that opportunity.
And there's always talk as you get closer to the election about, oh, this potential candidate represents these sectors. You should look at this group versus that group. Any thoughts on that?
Yeah, I wouldn't waste your time. There's a lot more ways to be wrong than right. Like, for example, clean energy boomed during the Trump years, and big oil did very well under Biden. I mean, no one would have guessed that. So that's very difficult to game out. The bottom line with politicians, the markets tend to over extrapolate how big of an impact they're going to have on interest rates and earnings. Those are the things the markets care about. The politicians, the system has a lot of checks and balances, and whoever's president doesn't really have as much impact as people think that they might. And if you look at history, there's no clear correlation between the stock market and whether there's a Republican or a Democrat in the White House. The markets have done very well under both presidents from both parties.